October 6, 1979. Paul Volcker announced the Federal Reserve would raise interest rates to whatever level was required to break inflation. The Fed funds rate eventually reached 20%. Inflation fell from 13% to 3%. It worked. The cure nearly destroyed the patient. 1979. The Iranian Revolution collapsed oil production. Inflation hit 13%. Carter had already tried price controls. They failed, as they had for Nixon. Volcker took a different approach. He stopped targeting the federal funds rate directly. Instead, he targeted money supply growth. The result? Rates went wherever they needed to go. By 1981, 20%. The prime rate commercial banks charged 21.5%. A 30-year mortgage cost 17%. Here is the paradox the historical record shows. The cure worked. Inflation fell from 13% to 3% by 1983. But the method caused two separate recessions, 1980 to 1981, 1981 to 1982. Unemployment hit 10.8% in December 1982, the highest since the Great Depression. Volcker received death threats. Farmers drove tractors to the Federal Reserve building in protest. The cure was correct. The price was enormous, and Volcker paid it anyway. The Federal Reserve begins its two-day meeting today, March 17, 2026. The rate is 3.5 to 3.75%. Inflation is above target. Oil is at $100. GDP just came in at 0.7%. The Fed faces the same dilemma Volcker faced, but with a much smaller policy tool. 20% is not on the table. The question is whether 3.5 is enough. Volcker broke inflation with 20% rates and a willingness to accept enormous short-term pain. If the cure requires a level of pain that democratic institutions cannot sustain, is the cure available?